Good morning, good evening. How is everyone doing? My name is Yordan. Most of you probably know me from the Telegram groups and the live sessions. And today we are going to cover the ideas of ranges. It is, I believe, a hot subject. We deal with them on daily basis. Pretty interesting, very reliable patterns if you know how to trade them, of course. And again, as with everything else, I'm not saying this is the only way to trade them, but it is one of the ways which I do like. Okay, it is profitable for me, so I would really like to go ahead and reveal some of the tips and probably things that we don't get to discuss that often. Just basically dig a bit deeper about all of these things, and I really hope it's going to improve your trading at least a bit. Hello, guys. I'm not going to name you one by one. Of course, thank you for being here today. Looking forward to your questions, okay, and discussions. As usual, I expect everyone to understand every single bit of what we're going to talk about. And please, if you have any questions, stop me, put your question in the question box, and I'll get back to it as soon as I see it. All right, so this is what we're going to cover today. I think we're going with yellow. So basically, we're going to talk about the types of ranges that we find on the chart. We're going to talk about defining them. We're going to talk about the two types of trades that we can take when it comes to these ranges. And of course, we're going to cover some examples based on all these things that we mentioned. And as usual, we're not going to cover only the clean ones, the clean examples. They will be there for better understanding, but here and there are tricky things, okay, which I included on purpose because the market is not always perfect, and I want you to realize immediately that you're not always going to get what you're looking for. So you need to understand from this very point how to deal with these things. And of course, a very important part before we begin is that you must have at least some basic knowledge about divergences and convergences. What is divergence? What is convergence? The more you know about it, the better and the easier this idea would be for you. And if you're not familiar with that, of course, we do have plenty of materials inside the Trading Academy Club, tons of webinars and discussions about divergences and convergences. We have free materials on the website as well. We have the Divergence University, which is specifically dedicated to divergence subject. So you can get your knowledge from many places, okay, and using your own pace. But of course, keep in mind that divergences are part of what we are doing. And I think we keep on repeating that with every new subject that we bring in, because it is simply a fact. Divergences are everywhere. They are very helpful if you use them the correct way. So why limit and filter what we're doing, right? When we can use divergences. Okay, so let's begin. The very first thing we're going to talk about is the types of ranges. Now, most of the people, when they hear range, they think about the horizontal idea of range. This is the classical range, and usually, well, people and traders refer to ranges in this form of the range because you have trend, and then you have range, and then you have trend, and then you have range, right? So that's why, in my opinion, most of the times that would be the association that you're going to make when you hear a range. In my opinion, every single pattern that I'm sure most of you, at least the people who had some experience with trading, You know about flags, you know about channels, you know about triangles, wedges, pennants, etc., etc., etc. Any market structure that puts the price between two lines, regardless of the shape of these two lines, it could be expanding or megaphone is what calls them, or it could be diamond of some sort, right? Any pattern that puts the price inside, in my opinion, could be called a range. Because what is a range? Range is something that has a top and a bottom. Okay, the shape of this range varies, and we have different names for all these market structures. In this lesson and webinar, I think it's more than enough for us to cover the basics, which in my opinion more or less covers probably 80% of the ideas. Okay, so we're going to also talk about the diagonal range, which we know again as a flag or a channel, and we're going to talk about contracting ranges, which are basically triangles and wedges. I believe so far that should be pretty clear. If you have any questions, guys, shoot. Now, when it comes to defining the range, excuse me, when it comes to defining the range, we need to talk about a few points here. Most of the times, when the range is being formed, regardless of its shape, it's not going to be perfect. And again, most of the times, when you're trading, things are not going to be perfect. And this is the first thing that we need to understand when it comes to ranges, because if you're looking for perfection, you're probably going to end up with one trade a month if you're lucky. Okay? You're going to have spikes, you're going to have closing prices, you're going to have new spikes, you're going to have clearance zones, you're going to have different things when it comes to ranges. And this is why my idea, okay, comes from there. That means we create a buffer zone, which is a small resistance zone and a small horizontal zone inside the range we're trading, in order to cover all these spikes, in order to cover the closing points. And generally speaking, we're basically looking for strong levels depending on the angle of the move. And once we can identify them, of course, it's not always the case. We sometimes have very clean patterns, okay? But most of the time you're going to need to create these buffer zones right here. And of course, it all goes back to the very, very basics, where we say supports and resistances, because at the end of the day, this is a resistance zone and this is a support zone. Support and resistances are zones, okay? They are not a single level, single line. They're always tiny channels, of course, depending on the time frames, depending on the structure, etc. Okay, so this is how we create a top zone and a bottom zone, or a resistance zone and support zone. You can call them as you wish. I really don't care, as long as you have identified these two zones that you're going to use later on in your trading. Okay, then the next thing is that each trend line, which means this one, okay, and this one and that one, must have at least 2 reference points. If you don't have that, you cannot call the line a trend line. And I think we've been teaching that, we've been learning that, well, not preschool, but probably 3rd, 4th grade, not really sure how your educational system goes, but we learn about it at very, very early age, right? So having 2 reference points is the next thing that it should be there. Horizontal ranges could have one high or low, okay? And that means something like that. Okay, this is the high that I'm talking about, and then that. The idea here is simple. We're relying on false breaks okay? And that's why when it comes to these horizontal ranges, there could be spikes that I usually like to take into account because they are part of this range, okay? Many times they're not going to be reached, okay? Many times the price is just going to find some beautiful zone inside that you can be trading. But if you have them, especially when looking for breakouts, you can rely on them as well because they're also part of your range, okay? And then we come to the contracting type of ranges, okay? This is where I usually would make the exception because most of the times I will be looking for the spikes and the highest or the lowest point inside this pattern. So yes, you can go ahead and draw the inner ones, of course, but majority of the times the way it's traded, you'll see that in a second, why I put it here as an exception, you're going to care about the highest high or the lowest low inside this contracting pattern, okay? And now let's go ahead and check out a few examples. Here is an example of a range, okay? You have spike, spike, spike. Here is your inner zone, okay? Closing prices, again retesting. Then you have these closing prices right here, right here. This one could be also included there, etc., etc. Okay, so this is basically the idea of creating your horizontal ranges or the channels. Here we have the same idea, and this is exactly why I included this example, because you have the spike here of the high, 3 candles, closing. You have again some levels, and this one is the only one. So what do? We can even include third line here if you wish, but this is already going too low. Okay, so I'm just going to mark myself this line and look how beautifully that level was tested. Exactly by the pip, boom, it counts to it, even though it's alone. Okay, same story happens below. You have a zone that you can mark, and then you have the spike below it. Okay, so always keep in mind those spikes because the price could go ahead and test them and simply try to clear the stops when it comes to it. Excuse me, guys. Here is another example. This time we have diagonal or a channel or a flag, of course, depending on the situation. This is basically a horizontal range with an angle, nothing more, right? It's absolutely the same thing. This time we have a trend. The market is trending up. And this time we can go ahead again and cover all the zones where the price had issues breaking immediately. And when you connect these dots, in the future, you can go ahead and rely that the price is reaching this specific zone, this specific level. And once you get your confirmations, you can start looking for the entries. Okay, here you can see the bounces, here you can see the breakouts. So this is basically how the idea of creating your zones, buffer zones works. Example of contracting, this is, in my opinion, a triangle. Okay, again, we can put the price inside 2 trend lines. When we connect the dots, we have 2 reference points. Boom, you have yourself a triangle. Okay, and in that case, just for the sake of the example, we can try to go ahead and create a buffer zone, and the buffer zone here would be something like that. On the top, the buffer zone would look like this, in my opinion. Why? Because we have this spike, this closing price, and then this one. Okay, and same story here. Of course, in the beginning, it might be a bit well, not strange, not complicated, not complex, but You just need to develop the sense of drawing your levels. Okay. After you practice for some time, I promise you guys, it will take you literally 5 seconds to open your chart and spot those, literally. And from there, you can start using the cycles, okay? Excuse me again, you can start using the divergences and so on and so on and so on. But in my opinion, everything starts with a level and a cycle. And understanding the levels, how they work, how they should be drawn correctly, is a major factor when it comes to our trading. And here you can see another example. This time it's very clear, especially on the top. Look at this zone. This zone is beautiful. So many times the price couldn't break above it. Of course you're going to mark it. And then when you mark this zone, you'll see immediately that it fits the previous two. Okay? And then later on that zone was respected. So that's more or less the idea. One more quick example. This time we have adjusted trend line. And this is also important. Why? Because in the beginning, when you start drawing, okay, your drawing would look like this. Okay, which is not, of course, ideal. I'm not sure I'm going to trade that. Okay, it's just too steep, and that's one big leg. That doesn't look correct. Okay. Then you have this trend line, which now starts to make a bit more sense. This one was broken, and we're finally going to develop something bigger, which corresponds to the size of the first wave down. Now this starts to make more sense, and this is where you need to go ahead and adjust your trend line. So what do? You just simply take the top, adjust your trend line, okay, to this one, and now we have second touch point. So now when I connect this one, I need to look up and find my other 2 points. This is the beginning of it, which means I'm going to draw my trend line from this very high right here. Okay, so adjusting should be always in place. Of course, if you want to have correct trend lines, keep in mind brokers do have different data feeds. That means what you're seeing might not be what the other trader is seeing. This is exactly where spikes and false breaks, in my opinion, appear. Because for some, the spike could be here. That means the trend line goes like this. For some, the trend line could be here, and that means the trend line is not yet touched. In this case, it's broken. Okay, that would be a broken trend line, and that would be not tested trend line. Okay, that's why levels are just step one of what we're doing, and when we're doing our analysis, this is where it starts. But it also takes more confirmations afterwards before we can go ahead and pull the trigger. And it's really, really, really easy, guys. Okay, now check out this small table of only 1, 2, 3, 4, 5, 6, 7 boxes, seven cells. Okay, we're going to look into breakouts and bounces, and the way it works for me, it's that simple. That's all I'm looking for. And trust me, it's more than enough when you're going to pull the trigger to check out whether you're going to break or bounce from this level. Nothing is 100% correct and sure all the time, but most of the time it works. Okay, so it could be 90%, it could be 80%. I really don't have the statistics. I'm not going to lie to you and make up numbers, but if you follow these things, you'll see that it makes a lot of sense. Okay. Now, what are we looking for when it comes to breakouts? We're looking for convergences. Okay, and quick reminder, what is a convergence? When the price is creating higher highs in an uptrend or lower lows in a downtrend. Okay, And when the indicators that you're using, usually oscillators such as MACD, RSI, etc., are creating the same thing. They are pushing up together with the price. Okay, they go hand in hand. Momentum, it's pure price action in my opinion. This is how I identify the momentum, and we're going to talk about that in the examples because I need to show you specific images, okay, besides the theory. I'm also looking for closing above a specific levels or closing below those specific levels, and for the price to hold. And this is, in my opinion, the most conservative way. Of course, you do give away pips. You sometimes might be missing the entry because there are different ways to enter, but it's more conservative. Another option is to go ahead with the breakout, which is slightly more aggressive, okay? And breakouts could be used more often in contracting patterns, okay? Again, specific situations, but most of the times my aggressive entries would be when it comes to contracting patterns. And that's pretty much all. Really, really that simple. Then we have the bounces. Okay, bounce would mean when you have a range, the price comes to this level, bounces from that level, and it goes in the opposite direction. Okay, and breakout would mean breaking the specific range that you have marked, regardless of its shape, and then continuing in that direction. So for bounces, I'm looking for, first of all, divergence to appear. Crucial, absolutely crucial. If there is no divergence supporting you in any way, you can't really go ahead and look for bouncing trade, okay? I'm looking for lack of momentum. And then I'm looking for an actual entry inside this pattern to give me the trigger. Okay, so I know I have reached the level. I know the momentum is slowing down. And I know that from this zone, first of all, because of the level, I should see bounces. Second of all, because of the divergence that confirms possible bounces, I should be seeing that up move. And third of all, not blindly attacking the level, I'm looking for some kind of confirmation to enter, which usually gives me good risk-reward ratio. Otherwise, if you're blindly attacking levels, by the time you decide to exit, and not having a hard stop loss usually means disaster for most of the traders, because you very quickly forget what was the plan, where was I supposed to exit. So in general, I don't recommend this type of trading. Okay, there must be always fixed stop loss or exit plan. But when I say exit plan, really follow that exit plan. And if A, B, and C happens, close the trade. Don't start praying to all kinds of gods. Don't start hoping. Don't do that. Okay, you must be disciplined if you're going to use this kind of risk and trade management. So that's basically all, guys. Breakouts and bounces, levels, breakouts, bounces, levels, breakouts, bounces. And here comes the question, which I believe most of you are asking themselves at the moment. Which of the two methods is more reliable? Which one gives better risk-reward ratio, if you want, or higher win ratio, etc.? What do you think? What's your opinion? Mayo, I like your answer. Let's just wait for a few more answers so we don't influence the vote. Interesting. Majority of the people say bounces, and now it's back to break even, breakout, breakout. Awesome. Any other opinions, guys, before I give you my opinion? One more bounce, one more breakout. Okay. In my opinion, it depends on the setup, and it's completely 50-50. if the setup makes sense, if the setup has good risk reward ratio, if you have the confirmations, you have edge. That could be a bounce, that could be a breakout. I'm not comparing both, I'm trying to combine them. And when you combine them, things and money and pips start to flow into your pocket. Okay? Also important thing to understand is that when you're looking at the 15-minute or 5-minute triangle or a range or a flag, things are a bit more aggressive. When you're looking at daily or weekly, then things are completely different. So keep in mind that on the lower time frames, of course, you're going to be trading more aggressive setups. Okay? Absolutely important, but again, for me, it's absolutely 50-50. If the setup is good, I don't care. It should deliver. You have the clear zone in bounces. Yeah, you do. Agree with that. Yeah, far away from that. Far away from that. I wouldn't ever. Okay. So if that's all clear, let's move on. Now, regardless of the type of the trade, breakout or bounce, I prefer to trade, and this is important, guys, in the main direction of the current trend. What does that mean? That means you could be using cycles from the report. You could be using price action. You could be using indicators. I really don't care. As long as you have a way to identify trend. And by the way, diagonal or flags or channels, when you draw them, they usually give you the trend already, right? Because this is obviously a bullish trend. And when the price is coming here, trading the bounce makes a lot of sense. For breakouts, things are a bit different because then we need to confirm it. But you will make more money, I guarantee you that, if you're trying to trade in the main direction of the current ongoing trend, especially on the higher time frames. So 1 hour chart goes together with 4 hour chart or daily charts. That means pullbacks on the 1 hour chart trading the higher time frames bounces. Okay? Something like that. When it comes to contracting patterns, triangles or wedges, etc., okay? I'm looking for the most recent high or low to be broken or to be broken and for the price to close above or below it. What do I mean? Let's say this is your contracting pattern. This is how the price was developing and you have a break above. That would be the most recent high of this breakout. And once this high is broken, I love it. It is more conservative and it makes more sense. Going and trading the breakout right here, again, could cost you money because we're going to see many times false breaks of these trend lines when you draw them. Okay? And again, why does that happen? I don't know if that's for sure, but in my opinion, first of all, you have stop loss hands that create this trend line breakout. Second of all, again, you have different data feeds where one trend line could be like this, the other trend line could be like this. And when this is 15 or 50 days away from you, that angle develops a gap that grows with every single day. So when the price comes here, that could be a test for one guy, that could be a test for the other guy. So for you, this is going to be a false break. For the other guy, it's going to be simply a bounce. Okay? And that's why relying on one more factor, which is the high or the low, in my opinion, makes a bit more sense and it's a bit more conservative when it comes to trading these patterns. Also, yes, this is important. Keep in mind that the nature of these patterns is to contract. So if you're looking to trade bounces inside triangles, so let's say the price was developing, okay, and you came to this point. Now you get the idea of and the confirmations for bounces, and you're looking for this. Keep in mind that the trend line is moving up, and that means your target is also closing the gap between the current price and the actual target, if this is your target, of course. Okay, so the slower the price develops, the closer you get to this target, and that could influence your risk reward ratio. And that's why most of the times I would prefer, when it comes to this type of patterns, to go for the breakouts and not the bounces, unless we have some huge triangle that's daily, 4-hour, weekly chart, okay, where I can be looking at, let's say, 150 pips, and I drop to the 15-minute chart, and my stop loss is, let's say, 30-40 pips, and I have 1 to 3 towards that level. Of course, I'm going to look at the horizontal levels and make sure that using some sort of angle, my risk reward makes sense together with the horizontal lines and the trend line, right? So that's basically the idea why breakouts are usually the better option when it comes to this kind of patterns and when we trade them. Breakouts instead of bounces. So far, are we clear, guys? All right. Moving forward, going to horizontal ranges. Now, check out what's happening here. We had the price moving lower, then we have a bounce up. This bounce up comes with double wave, okay, comes with divergence, tiny range on the lower time frames, and then another spike. Nothing goes here, okay, as a breakout. Instead, we're creating divergence, and boom, then the price starts to fall. So what do we have at that stage? Excuse me. We have level number 1. We have previous levels right here as well. We have level number 2, top of this range, and spike, and all this is coming together with a divergence. Price starts to push lower, and as we approach the previous low, where we would like to see breakout and continuation, if this trend is going to continue, okay, we want to see the price continuing lower and lower and lower. Instead, we came to that zone, corrections, and on the next push lower, we started developing divergences. You see that? So, excluding for a second the macro idea here, zooming into the specificness of this move right there, and looking at the bigger picture, just try to zoom out a bit for a second. What do you have? Divergence with a false break, and then you have the next swing being reached together with false breaks and divergences again. What does that tell you? Does it make sense to start looking for buys in that situation? In my opinion, the answer is yes. The price managed to clear exactly the spike here. Even if it creates the false break, I have no problem with that. Okay? And it's still fine. Why? Because at that stage, you could be still uncertain whether to go for the buys or not. And I would agree with you. Why? Because the range is still young and it's only a potential range. It could easily break and continue, right? However, if we look closer now, we can see that there is another range that was created here, lower time frames. Just use your imagination of these levels. And we have the trend line from the lower time frames as well. Because on the lower time frames, if this is our 4-hour chart, on the 1-hour chart, this is going to be a double wave, perfect double wave with divergences, false breaks, and then this trend line is broken. Look at the size of this green candle pattern. Lovely, isn't it? That spike right there is also breaking above the most recent high. So when we put together the 1 hour chart, the 4 hour chart, the levels, the divergences, everything together, and on top of that, we see breakout not only of a trend line, but also of the high, the swing high before that of the most recent double wave down. Things start to make more sense. In your opinion, does that make sense for a buy given all the facts that we have collected in our list? The checklist that we mention so often. It does, right? Makes sense. So then what we need to do is check out the risk reward. If this is our risk reward and that's the top of the range, okay, and usually I'm not going to count it towards this extreme high or the spike. I'm going to count it towards the very bottom of it. Why? Because I want to be conservative. I don't like to miss the move that happened up to here and miss it by 5 or 10 pips. Okay, that's stupid, simply stupid and greedy. So counting the risk reward from that zone to that zone, does it make sense for me? I think it does. I have more than 1-to-1, which means at least my first target is going to be collected. Okay, or if I'm looking for the zone right there and trade the full position, I'm going to put the stop loss here. I should have enough room for the price to correct and continue later on to that place. Okay, Clive, exactly. But I'm not going to repeat what you said just for the sake of filtering it, okay? So I think it makes a lot of sense, exactly. You see, boom. There you go, this is your move. What happened here? Breakout, 1-to-1 collected, stop loss. Well, at least in my case, it will be break even reached right here. All right. If you're on a different position where you're going to collect, let's say 80% right here, and then you have the remaining, if you're trading one lot, you have the remaining position of 4.2 lots, which even if it reaches the stop loss, you're still going to make money. This is also, by the way, a way to manage your trade, because then you don't choke it. Okay, if you move the stop loss to break even, many times you're going to choke the trade. In this case, as you have the idea of ranges being developed, you can let it run, and that would make sense because you're going to reach almost the top. Okay, and in that case, by the way, look at it. It did miss the bottom zone of this buffer again by a few pips. Okay, so this is what I'm talking about. Do not be greedy by all means. Collect your profits when they're available to you. You made the right decision. You calculated the risk. You did what you were supposed to do and you got the move. Take the money. Okay? What is the typical time frame to trade ranges? I would say 4-hour chart. Well, for pound kiwi, for example, you can drop to 1-hour chart, and of course it depends on the range. I don't care about the time frame. I care about the distance between the range. If I have to pay 15 pips or 10 pips spread, and this thing is 50 pips in total, and my entry, of course, is not at the bottom, I'm entering around 1/3 or 1/4, okay, of the total range, which is going to leave me with, let's say, 40, 35 pips move, and I already have to pay 5-8 pips spread. Does it make sense to trade it? Of course not. It's forcing. If, on the other hand, this is 150 pips, then that situation would make sense, because then I have more than enough room to make money, good money. Okay, Mayova, those are most of them live examples, and later on, yes, we will have majority of them. I didn't go back in the years. Well, basically for the daily charts, maybe I went back, but it's all from the last few months. Okay, so it's absolutely live market examples, yeah. And if you want more live examples, please do follow up the live trading rooms where we do cover these things live, of course, as they develop. Okay, so this horizontal range that we were talking about now starts to make even more sense, because now those two are absolutely confirmed. It bounced first time, it bounced the second time here, and now the price is pushing back up. What do we see now? Divergence on histogram. Perfect. We do see bigger double wave. We do see smaller double wave. Perfect. I draw the trend line for aggressive entries, and I draw the most recent low at the breakout. What do we get here? False break, price attempts to go higher, and it could go higher because this zone was never cleared. So going and selling aggressively with that trend line breakout is a no-go for me. Why? Because I still have all this room above. I don't have divergence on the MAs. So this level is absolutely acceptable to be reached. That would be the only reason right here. So what do we do instead? Well, what I do instead is to look for that extra confirmation. And that extra confirmation comes with the breakout of the low that was previously created, the most recent low right here. So now I know that I have a trend line breakout. I know that the price is refusing to go up, and I continue making lower lows. And when we have a downtrend, this is what we want to see. Lower lows being created, most recent high to hold, right? And boom, there you go. That would be your entry. Aggressive stop was the most recent swing or the highest swing. And this is where you should start calculating the risk reward. Okay? So that's the whole idea, guys. If the risk reward doesn't make sense, I would simply going to skip it or use the aggressive stop loss right here, and then you're looking at quick profits. Well, quicker profits because the risk reward will be improved by at least 20% in that case. I see questions at what level we will go to 15 minutes for entry on a 4-hour chart range. Well, easy. Once the price comes inside the buffer zone and reaches that buffer zone, you can go ahead and drop lower already. That means if you do what you were just asking to me, this double wave could be traded right here, because on the 4-hour chart, this leg, right, the final leg lower that is now confirming with divergence and level, could be traded on the 15-minute chart. Good question, like it, like the way you're thinking already. Another question, are round numbers often good areas for horizontal ranges? Yes, but I wouldn't blindly rely on them. It's easier, well, it's not easier because it's manual work, it's not indicator, but much more efficient is the word when you go ahead and place the lines and draw the lines yourself. Because the market, let's say this is your round number, is going to spike through it, and you're going to miss this part or that part or the closing parts. And closes and spikes are important. So you can use it as an extra confirmation or extra validation. Let's say you have a round number right here. So yeah, by all means, that makes sense. Or you have a pivot point here. Perfect. Perfect. But I always do it manually. I don't know, it just seems better and more efficient. Because indicators, they follow a given logic and they're strict. They're not flexible as the human eye or the human brain. Okay? That's the only difference. But as an extra confirmations, definitely, yeah. Mayova, you're welcome. So that would be one of the ideas here for trading the bounces and the continuation. And of course, always keep in mind about the risk reward. Now using that same range, okay, let's see how it managed to develop. We got the range within the range. Look at it. Madness. Okay, the price is contracting. Breakout of the inner range suggests further continuation down, and this is where the breakout happened, and this is where we got lower lows, convergence idea from these two lows and from these two lows again. So basically the price managed to break both of them, creating momentum for us that we can rely on. And this is coming from everywhere. MA's histogram looks beautiful. And this is the very first sign in that case. And this is what I call a tricky example, okay, that we're going to see continuation lower. Why? Because the moment we have reached the bottom, okay, the bottom buffer zone, the supportive zone, we never created divergence. Blink, a red alert. Something is going on. There is momentum. We're probably going to break out. Then the breakout of the range. Then the price makes a pullback towards the inner range, right here that I marked with this white box. And look where it stops. Okay, this is your zone, the supportive zone right here. It stops right at the top of it. And guess what else is happening? Boom, you got hidden divergence as well. Is it an aggressive entry to go ahead and sell here? Yes, it is. But does it make sense? By all means, yeah, it does. At least in my opinion, it does. There is not a single factor against you besides the level that we respected and bounced from, but that's all. We already saw the bounce, which means we're basically not selling inside this level. So selling here would be risky, right? Because you're selling inside the support. That's all. So hidden divergence develops, breakout, continuation is expected. Perfect. Now, guys, did you notice what actually happened here? Did you see that? As we were talking about this horizontal range for, I don't know, 5 images, 3 images, we actually developed a contracting range at the same time inside this range. And when you look at it as a triangle, this time you have breakout that goes and retests that broken trend line. And this is where the hidden divergence also appears. And you'll see how that's one level, horizontal level, that's the other level, which is the dynamic level. And this is how you mark yourself. Ever since you got the breakout, this zone becomes an action zone immediately, because this is where you can now expect the price to bounce ideally and continue lower. Okay, so what do I do many times is I'm going to draw my horizontal levels, then I'm going to remove them, and I'll try to see the image clear without anything on it and try to spot another pattern, because many times they will be on the same chart and you're going to miss one of them. Okay, and if let's say you're trading the triangle and you missed this inner range and you're waiting for an actual retest of this trend line, you're never going to get it, when in fact the market told you already that this is the zone you should be waiting for. Okay, it's right there. You just need to learn how to spot it. That's it. So horizontal ranges, we move on. We have again a horizontal range, okay? Many spots on the way. We have spike, we have spike, we have spike, we have the first spike. Basically, I have the split the zones that I'm looking for, the buffer zones, into two rectangles, okay? Covering all of them, because in between we have this space which I didn't want to mark with such a big formation. It becomes really interesting. However, does the risk reward make sense in that scenario? You have double wave, you reach the top of it. You have the divergence here forming on the histogram. You have the previous low right there, which was broken. You have one more here, but that's not the most ideal low for me because we didn't have a move afterwards. We only had here a flat move. And overall, this is the more interesting situation for my eyes. This is your trend line. We're going and breaking both of them. Does the risk reward make sense in your opinion, guys? What do you think? From here towards any of those lines, depending on the levels that you see. Kevin, agree with you? Yep. Everyone says no. Of course, no, it doesn't. Why? Because you're almost at the middle of this range. Almost at the middle of it. What do? We wait for pullbacks. If you get all of the confirmations you're looking for, you wait for pullbacks and sell here somewhere, or you wait for pullback, another break lower. So let's say the price does this, and then you're going to cover this high with that entry towards that level. So either improve the entry or improve the stop loss. That's how you make sense of your risk reward ratio. Okay? Tricky example, but interesting one in my opinion. And this is exactly what you got. Here we go. You got the pullback towards the zone and you got the breakout below the zone. So either or, in my opinion, would make a lot of sense, but definitely not selling immediately right here with protection above that zone. That would not make a lot of sense. Okay. Now let's check out this example. Let's see what we have there. Next screenshot, guys. Seems like momentum is forming. Price action plus MAs start to create the move down. Now this seems like, okay, we might be breaking, right? However, there is divergence on the histogram, and this is a warning sign. Okay? So what do we do in that case? If you're looking for sales, you need an extra confirmation after pullbacks to go ahead and pull the trigger. If you're looking for buys, you need an extra confirmation, which we don't get inside this zone, at least not on this time frame. Do we have a trend line? Not really. If I go ahead and draw a trend line here, look where my entry is going to be. Even closer to the top than to the bottom. Okay? So the idea of this example is to tell you that not being in a trade is also a trading decision. It's simply not there. Whatever you do in this case, it will be forcing. Okay? Even if it's slightly forced, it will be forced. And when you do force trades, most of the times you're going to lose. And you're going to accept that drawdown. Okay? It is simply not there. That's all. Next one, another horizontal range. Okay, we have clear impulsive breakout. What do I say and call impulsive? This is an impulse wave for me. It's not slowly breaking, developing. No, boom, it just moves. And that's the easiest way to identify breakouts. And when it comes to horizontal ranges and breakouts, usually I would like to sell the pullbacks, guys. So let's say the price did that. I would not go ahead and sell here. Okay? It's simply not in my nature. Many people do it, and then the way they do it is you sell here and you protect the zone that you have created, which most of the times is going to give you pretty good risk reward ratio. Okay, then you calculate the range size and the duplication of this range size, and you're looking for the target towards this duplication, or once the divergence starts forming against you, and then you close it. However, the way I do it is slightly different. Once that happens, I wait for pullbacks, okay? Then you start seeing hidden divergences. However, there is really no trend line available at that stage, at least not on the 4-hour chart. On the lower time frames, you might be able to go ahead and find something, okay? But on the 4-hour chart, not there. Then, on the other hand, we have break below the low. So that was one low, that was another low. Even though this is all stuck inside one candle, it is some sort of a low, okay, coming to the level. So that would be slightly aggressive, but it would make some kind of sense later on. And then we come here, okay, testing, retesting that zone, failed to go ahead and break it. And then we break below it, okay. Move down provided, risk reward makes sense, target in the pocket. Then another bounce up, another attempt to break above it. You have the first low, again, not ideal because of the 2 candles rule here. And then another low. Now, if we go ahead and drop down to the lower time frames, you'll see how these things look on the lower time frames. The move starts to develop, and this is the very first time we got some sort of divergence right here between these 2 highs. Okay, again, we can talk about the quality of this correction, but let's assume it was a correction and we count it as divergence. Okay, and boom, you got yourself a false break. So the second you start forcing things, you're going to lose money. Okay, you see that? 2 candles right here, not a valid correction. Can we go and look for 2 waves? Again, that's not the most ideal 2 waves on the 15-minute chart. So using the divergence here, okay, is not optimal because that's not really a correction. And then when we go ahead and sell the breakout below this low, we're going to lose money or the trend line. However, on the next push up, where the divergence of the MAs was created, when you had this move down, okay, things are a bit different. And once this low is broken, boom, you start to make money. Next time we go ahead and revisit, we have the divergences here, okay, and we have a trend line, this time a beautiful, nice trend line, and lows. So being aggressive here with the breakout of this trend line would make sense because you win that many pips. You're inside the level, you know you got the breakout and the price is still keeping below this zone after all these attempts. So does it make sense for a sell? I would say yes. It's still more aggressive, but I would say yes. Why? Because I have nothing against me. All the facts are saying sell. Then, if you want to be more conservative, set yourself an order right here, protection right here, and either or, you should be able to make money because that's the previous swing, that zone, which was reached, and look how it was reached. It came to it, fight, 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 broke below, another fight, and only then breakout. Okay? Any questions, guys? Or we move on to the other types? All right. Let's talk about the contracting patterns, in other words, triangles. What do we have here? Push down, swing high. And this swing high so far is holding, at least from what we're seeing, right? Now, when we're looking for the breakout of the range, this range, as I said in the beginning, I would love to see the most recent low being broken as well. So if we start following the lows and the highs, you'll see that we got here a break above the trend line, right? But we never got a breakout above the previous high. So boom, that's money saved that remains in our pocket. Of course, assuming, well, we cannot see the higher time frames, but assuming that this is your last swing and this is your last swing here, top and bottom, we are still in a bearish momentum, okay, because we are keeping below that high. So assuming our trend is down, we want to anyway focus on sells. We have a low here that was created and formed, and it was broken. However, do we have a breakout below the trend line? No, we don't. This is where the last low before the breakout was formed, and this is where the false break happened until the price moved in the original direction that we're following. And now we have low, now we have trend line pretty much at the same level and a breakout. All right, beautiful. You can go ahead and immediately sell at that stage. If you want to do it conservatively, no problem. Wait for pullbacks and sell on the pullback because you're waiting for close below. Also fine. Keep in mind, in those situations though, you're going to miss opportunities. Okay? So I think that makes a lot of sense when we draw all these things and go one by one to each low, to each high, and dig deeper into it. Okay? Next one. Look, what do we have here? Now, this one is a bit trickier, okay? We have this range which is being formed, and we have the first breakout right here. This breakout, once again, does not provide break above this spike. And again, we can go ahead and have a discussion about the quality of this correction, but in my opinion, this is a strong level on its own, simply by drawing this, okay? And if you drop lower, you'll see that this is a small, tiny range, which anyway we want to see broken, and in that case, we're just using the high. Boom. What happens then? Pullback, correction, pullback, and now we have this high. This high was finally broken. Okay? Protection, and we're looking for the buys. Does it make sense, guys? Do you follow what we're talking about? Trend lines, highs and lows, breakout about both of them, and then continuations. Okay? Of course, we want to see either both histogram and MAs being on the same page, or at least one of the two. In most of the times, you'll see the MAs being there for you. Okay? Spike, break above the spike, pullbacks, or immediate entry, simply because the pullback here would be just a few pips, and then looking for the sells. Where do we protect? Look for previously created lows, but these lows must make sense. Okay, this is not an actual low, in my opinion, that we can go ahead and protect. If I would have to pick an aggressive stop, I will do this. Why? Because I have a horizontal level here, and I'm going to rely on this horizontal level. So let's say I'm going to put my stop loss right there. So even if that happens, you will be still protected. Keep in mind, again, the trend line is moving up, so that should be saving you anyway. Next one, channels. What do we have? 4 reference points: high, low, low, high. At that stage, we do know that we're trading inside this channel, and this is again a diagonal range. Okay, what happens here? Bullish divergence forms right here twice. Actually, that was the first, that was the second one after the bigger wave. Both of them provided amazing opportunities, and I believe we traded this one live, if I remember correct. Okay. Divergence forms on the MAs, false breaks 2 in a row. Now we're already inside this buffer zone. What do? We look for entries. Where could be our entry? That was the last false break. If you find yourself a good entry on the lower time frames, you can attack this high or this high. Tiny stop loss, and you got the spike up. Boom. Then you have continuation. Another divergence was formed. Okay. Well, again, we go ahead and reach this buffer zone, and now we're looking for buys once again. That's the last trend line, which provides you with an entry only there. If you want to be looking for entries before that, you have yourself a high. If you want to be looking for more aggressive entries, go ahead and use this second leg and try to find yourself an entry on the lower time frames at that point right here. You have the level, you have the 4-hour chart divergence. So on the lower time frames, any entry would make a lot of sense in my opinion. Then we move forward to the next one. Price is going to the top. Again, divergences start forming. That was the low that was created after the divergence, the most recent low, okay? Not the middle point of the divergence, the most recent low, guys. There is a big difference between the two. That low was broken, okay? And this is where your entry would be. Protections, aggressive or conservative, up to you. And this is where we should mention re-entries. If everything is suggesting continuation lower, which means level, divergence, okay, and no breakouts, and you get cleared, let's say that was a spike that cleared the stops here, but again you have divergence and you have no signs for continuation lower, what do? We look for the entries. So if you lost the first one, by all means I'm going to trade the second one as well, because I know that was most likely stop loss clearance, nothing more. And then boom, you got the move. That's all. Another example. This is the euro pound. This is why I said we have live examples, because for me, this is still live situation. Okay, that's the current market price more or less after the screenshot. We got the 4 reference points, and ever since then, we can be looking for bounces or breakouts. Look what we have here, divergence. We can, by the way, also attack divergences. That's perfectly fine. It's a bit aggressive, but still possible. And you know that the price is pushing higher, okay? Every time the price visits the top, you get yourself whatever you need to get and then look for the entries. Is that a possible entry? In my opinion, not really. Why? Because if you're trading the breakout, the risk reward doesn't make a lot of sense. If, however, you get the divergence on top and you drop to the lower time frames and you find yourself step trading ideas or anything else, why not give it a shot from that zone? You have all this to the bottom to enjoy if you're correct and the price doesn't break. Okay? However, let's focus on the breakout. Bullish breakout appears, okay? We did break the most recent high that was created by the price, and look what happened here. We have spikes, we get inside the zone, and then boom, the price is simply pushing above, making a few daily candles above it, and then giving us the the push lower to retest. And that's why I'm marking the whole zone, because this whole zone is my actual resistance. Okay, so what do we get then? Trend line after a double wave and a spike that we can look for breakouts. And now let's zoom in slightly and see what happens there. There we go. This is your double wave. This is the high. this is the trend line. You do get hidden divergence as well, and everything is suggesting that we're going to continue higher. Okay, extremely simple, nothing new, guys. We've been talking about these things probably for months or years. In this lesson, we're just putting all that together, the way to combine it to make money. Okay, in my opinion, the optimal way, well, at least for me, of course. Okay, and this one I do believe we covered in the previous screenshot. Look at it, double wave up, now a bit zoomed, of course, but this is the tricky situation I was talking about. That's the spike that was inside the zone and the previous spike right here. Now MAs are creating higher highs, which means possible continuation up, while the histogram is creating lower lows, which means possible continuation lower because we have divergence. And this is where the price action comes in play. Okay, and what does the price action say? We don't have a breakout of the level, we don't have a close above the level, and we're keeping below the previous spikes. Even if you're counting on this one, okay, it's still not broken. So what would be the suggestion in this case? Continuation or a reversal? I would bet on a reversal, guys. That was never broken. Even if I'm counting on continuation, where is it? Okay, we want to see momentum. We don't have that momentum. We're still inside the buffer zone. Okay, so price action always comes first, and then we start confirming with the indicators. Okay, so amazing bouncing trade. This is the 4-hour chart. Okay, so divergence was formed, ABCD. Again, we can talk about this correction, but for the sake of the example, please bear with me. Trend lines, lows that were created and lows that were later on broken. So basically the idea of the step trading is simple. You get breakout, pullback, retest of the broken trend line, and then continuation. Once the low that was formed during the breakout is broken, you go ahead and attack it. Then this is your entry, this is your stop. Also, in that case, I would protect here because it doesn't make sense to risk it for a few pips, right? And then boom, you have all the space towards the bottom. Okay, another low that you could be relying on, perfectly fine, no problem. Whichever you decide to go with, this is the middle point of this double wave, so that would be now a convergence as well. Okay, so as a quick summary, it all starts from a level. The level must be in place. The price must be very close to it. You're not going to get the setup you're looking for all the times. That means if it's not there, don't force it, guys. Skip it. Make yourself a plan. Print yourself or draw on a piece of paper exactly what you're looking for, very specifically, as specific as you can, and put it next to you. Once this setup appears, go ahead and check out your cheat sheet. If it's there, take it. If not, don't try to bend the rules. Always mind the risk-reward ratio, which means if the price made the move, don't try to catch the last few pips. Okay, if you lose, you're going to ruin your performance, basically. Okay, we must always confirm the idea with divergences or convergences. Always. Aggressive entries are best when the level was reached and tested. What do I mean by that? You have a level, okay, and the price is coming, and then you get a possible entry. So selling here doesn't make a lot of sense for aggressive entry. I would like to see the price going and clearing the zone And only then aggressive entries make sense because the zone was cleared. Before that, only conservative because we still have room to the upside. That's the idea of this sentence. And also keep in mind the reattacks. Okay, the reattacks are a perfect way to decrease the drawdown and maybe even turn the first loser into a winner depending on your risk reward ratio. Question: what can we do when we're stuck probably in a range? Mayo, I think we just spent 1 hour explaining exactly that. What do we do when the price is in a range? Other questions, guys? All right. So, wishing you a wonderful day. We're going to take the talk back to the Telegram groups. If you have any questions after you watch this thing and you start playing with the ideas, please ping me or leave your comments in YouTube or Telegram or private, and I'll be glad to answer them all. Thanks a lot for the good words, guys. Thank you. All right. Bye for now.